We've seen enough to think that the Reserve Bank Board is going to raise interest rates at its November meeting by 1/4 percentage point. Had inflation stayed on the track that they were previously expecting, they might have been able to hold. It will be a finely balanced decision for them, but the November decision will probably be an increase. That's because the September quarter CPI data was a bit higher than they'd been forecasting a few months ago. At 1.2%, inflation is actually quite a bit higher than that where they want it to be. They're trying to bring it down, and it's going too slow for their comfort levels. The Reserve Bank won't just be looking at the inflation data, they'll also be looking at the outlook for the labour market and for economic activity more generally. The labour market has clearly turned. Unemployment is no longer at the trough that it was earlier in the year, it's a little higher than that. Underemployment is rising, job vacancies are falling, although they're still very high, and employment growth is really only tracking at the very fast rate of population growth now and not increasing faster than population growth. So although the labour market is still pretty robust, it clearly has turned. In terms of economic activity, what we're seeing is a very weak consumer sector. Households are being squeezed by high inflation, by rising tax take, and for some, by higher interest payments on their mortgages and other loans. People are having to adjust. Some of them are changing their spending plans, some of them are trying to seek extra hours of work, and some of them are dipping into savings. But in all cases, households are very gloomy and are having to adjust. We're seeing very weak growth in consumer spending overall, even with fast population growth, and that means that overall economic growth is relatively slow, even though other sectors of the economy are actually more resilient.